Well, I'm going to the city and I'm gonna do a city show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone reclining, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go ask
Hi, I'm Steve Miller. Call me Slim. And this is the askSlim Market Week. It's a look back at what happened in the financial markets in the past week, and a look forward at what might happen in the next week, and hopefully lots of great ideas and opportunities for you throughout this show. Well, the stock market rebounded sharply last week as investors took heart in a slowing of new cases of COVID-19. Stocks blasted right out of the gate on Monday as the Eurozone rate reportedly showed a slowing of infections, and the University of Michigan researchers came out and said that they had a vaccine related to SARS that showed good promise. Monday, this explosion saw the Dow move up 1,627 points for a gain of 7.73%. Another one of those that goes into the top big gainers ever. Tuesday, the market tried to move up again, but then hit the resistance that we had talked about and then backed off sharply. It was one of those rare, huge reversal days where the S&P 500 had been up 90 points and closed down on the day. But buyers then showed up again on Wednesday and really accelerated to the upside after Sanders quit the race. That essentially means no more socialist threat. What a joke that is. We are now, this country, under the greatest socialist threat in the 200 and something years that we've been in existence. It's unbelievable that they could be thinking that way when our Federal Reserve is buying everything out there and now talking about buying junk bonds, that's corporates, and even there's discussion about buying stocks. So huge violation of the free markets, and the Fed is in there taking over everything. Speaking of the Fed, on Wednesday, the FOMC minutes came out, and they said they would do whatever it takes. They see a zero interest rate policy for the foreseeable future, and they were all quite alarmed at the sharp downturn in the economy. Seems completely oblivious to the fact that they set it up, and coronavirus was simply the trigger. Thursday, an early surge came after there was little reaction to the new claims for unemployment, which again moved up to a record amount, 6.6 million people, to now about 17 million people had claimed for new claims for unemployment over the last 3 weeks. Then the Fed said that there was an additional $2.3 trillion coming out in loan programs. And in there, they were going to be loaning to everybody, everything, and buying the high-yield corporate bonds. And you can see with all of these programs coming out and the massive amount of money going onto their balance sheet, they will truly do anything at all to get these markets up, to make us all feel better and not get a sense that we're in the total collapse and chaos that we are truly in. The market stalled then after that rally on Thursday as Russia and the Saudis did come out and agree to a 2-month cut in oil production of about 23%. That was way smaller and way shorter in duration than anybody had hoped for that wanted oil to get up. And oil just turned around and absolutely plunged 8% on the day, and that was after being up. Friday, of course, the markets were closed, and that's when I'm doing this recording. So wishing all of those who celebrate Easter a very, very good Easter, or hope you are enjoying your good Friday off. So now, back to the markets. Maybe we should stop calling it stock market. Let's just call it Fed market. They will do anything that they can to stop the decline and avoid what they obviously think is the next depression. And that's probably true. We're probably in what is a contraction that is well worse than 2008, 2009. So they're very willing to blow up a bigger bubble to stop the havoc of their bubble that popped. It's more and more bubbles and more popping and more debt, the drug of debt, and they're willing to shove this crack cocaine into every orifice of the economy to try to bolster it up. In the meantime, the money again is going to go into the wrong areas. They're not going to be saving just the companies that deserve to be saved. They're going to be saving the ones that deserve to be out of business. And it's ridiculous that we live in this world of moral hazard. And essentially, they are sticking their hands deep into the pockets of our grandchildren. And let's just call it financial molestation is the way I look at it. So it's a horrible economy that we live in, a horrible thing that's going on with COVID-19, and a horrible thing that the Fed is simply in a takeover state right now and is willing to do anything and buy anything and own any portion of anything to try to stop what is going on. It is the stupidest approach I could ever imagine. And I believe in helping the people, but I don't believe in corporate welfare, and that's where we are right now. So this big rebound of 25% off the lows came from a very oversold condition. But the market rebound, that's hardly reflective of a potential economic rebound. The economy is broken, and what's left the Fed owns. That's the world we live in right now. And the earnings prospects for the next year or longer are dismal. The recovery is going to take a long time to get, and the companies that were making money based on a false economy are not going to be able to do that anymore. When they gear back up, they're going to gear back up at a sharply reduced level, and earnings are going to be pretty hard to come by for a great portion of the economy and companies listed in the stock market. So we're moving up. We've come up about 25% off the lows. And the question is, again, that I asked last week, will you get hooked? The reset is here, and that means a whole new set of valuations. And right now, with this recovery, the market is more than fully valued. For the week, stocks, well, they gained a range as the S&P 500 gained about 12%, NASDAQ around 10%. The Russell, which was so depressed and had so collapsed, moved up about 18%. So the NASDAQ was the weakest, the Russell the strongest. Bond market, 30 years, up 4 points. The TNX, the 10-year yields moved down 13 basis points. Gold exploded to the upside, acting pretty much as we had anticipated in our analysis. Thank you for all the people writing me emails that you had done so well on this gold move. Silver moves up even more. So gold $90 up 5.4%. Silver up $1.40 up 9.6%. And simply the movement is because fiat is trash. That's where we are right now. All of these countries debasing their own currency. The only true measurement of how much they're going down is against real assets. So now we're in a period of deflation with gold going up, and that's because gold is anticipating that the government will do anything and destroy paper currency to do so. The dollar moves down about 1.3%. You ain't seen nothing yet. And that move is, in our opinion, in the topping process, and we'll talk more about that. Oil down $5.80 on that disappointment over that weak deal between Russia and the Saudis. We think that it is near the bottom of the range, and I'll show you that again when we get into the short-term view, which is coming up very quickly. So I want to give you a little reminder here. This is going to be a short show because it's a Friday holiday, so we're not going to be doing the best and worst for the week or Investor Impulse. We'll be back to that next week. If you do love our analysis and you want to learn how to be a cycle analyst, and we have so many people that are doing this right now and that are taking our cycle analysis workshop. We are now in our final week of our 30% discount for that. So please do write Matt at askSlim.com. He will send you a link for that 30% discount for our 20-module cycle workshop took me 2 years to write, 6 months to produce. And you can go on our website to the top nav bar, and you'll see workshops, and go to cycle workshop, and there's a whole informational page there. So please do go look at it. You like our videos, please do go on YouTube. You'll see we're posting videos there on a very regular basis. Make sure you give us a thumbs up because you like our videos. If you don't like what you see, you can put in a comment and tell us how we can do better. We'd love to hear from you because we want our viewers and our members to always learn from us, and we always want to be much better at what we do. And follow us on Twitter at askSlim. That is the opening. I've got one more little thing to tell you about right over here. So don't fast forward right now. This is very important for a lot of you people, especially shorter term traders. We have some great stuff going on in here. I want to just tell you really quickly about our stock index report live stream. This is our users are growing and growing in here. This is a 15-minute chart of the S&P 500, NASDAQ, and the Russell. This runs live from the opening all the way through the close. And what it has on here are the important supports, resistances, and the acceleration zones. We have a very, very high probability, well over 80% of once it gets to the acceleration zone, the yellow areas, that it moves all the way through it. This is how you get the very, very big trades and raise your overall success rate because you catch the big swings. The reversal scout is a momentum indicator that really helps you stay in the right side of the direction. So when you get a rollover in the area of the resistance, as you see right over here, well then basically it's a pretty high probability that you're going to be entering into some kind of a declining phase. So you can see it goes up with the reversal scout, it goes down with the reversal scout, it stops at the resistance, nailed the resistance here in the NASDAQ right over there, and then move through over here on the Russell, and you can see very clearly the Russell was much, much stronger in here looking at that than the NASDAQ. So pairs traders would be buying the Russell and shorting NASDAQ because this screams to you about the strength and weakness when you look at it. This is an amazing piece of work. We give this to you fresh every day. You get a Zoom feed that lets you watch this live right on our charts. You don't need any other platform. Fantastic. I mean, literally people would pay thousands for this kind of information. That's not exactly what we're going to charge you. Let me just tell you right now about this special, the special trial for level 2 membership. What you're going to get is the stock index report daily. That's a daily report. The stock index report live stream that I just showed you. You're also going to get our weekly stock index report. All of this has all of my charts on there, so you'll get an idea for the bigger picture. And the weekly ETF review. We look at important sectors of the market. You're going to get our unbelievable Slimulator Momentum Tracker, which has over 1,000 symbols in there with all of our proprietary momentum indicators, and we're going to tell you what we think the condition of the stock or ETF or future is. And what we think is going to be not future, ETF, stocks and ETFs. And we're going to, you're going to see just an incredible amount of information and ability to sort and to look for stronger and weaker stocks through great capabilities and features that are in there. And of course, you're going to get the askSlim video library. 500 videos we have in there now in 8 categories. You're going to learn so much about our tools for for technical analysis, our stock sectors. You'll get our future speak on Wednesday. IRA MO, which we do on occasion in there, and so much more. There are just an unbelievable amount of videos, and you're going to learn a lot about my style of analysis. How about this? A 1-month trial for $22.50, and even if you want to go for a quarterly trial, Matt has got a great one on that also. Write Matt at askSlim.com, and you will definitely get an opportunity to see this amazing amount of work. Just $22.50 for 1 month. Binge watch the videos, learn all of this stuff, and if you don't like it, just cancel. No problem with that at all. But if you love it, I guess you'll be staying on. So that's the special level 2 trial membership. Okay, so now let's move on. Whereas, as I said, this is going to be a shorter show because we are going to skip some things that we normally do because it is the holiday, and we will bring that back in the next week. So let's take a look here at our daily charts. First of all, we'll talk about what we expected to happen. Well, we like to be accountable, and sometimes when we are not great at our analysis, we say that. I'm going to say this: last week we were great. The weakness that we had was that the stock market moved above the top of the range that we thought we were going to see. We had been talking for for about a week or a little longer of the market being in a range and testing up at the 2660 area, and the S&P 500 that actually moved through there quite significantly, and we have raised our range in there. Interesting, I got some comments and criticisms for the fact that we don't stick with our analysis. We move our analysis, and that's kind of a joke because of course we move our analysis. We want to be flexible and on the and adapting to all of the data as we see it. So you'll see that as we do our analysis. Every week it changes. In fact, every day it changes because we take the new information and then extrapolate the highest probability. So that's what we do, and that's what you'll see right over here. Overall, we're going to give us an 80% rating. We were very good on light crude, the dollar, the bond market. We were almost perfect on gold, except that it didn't correct down as far as we thought, and then blasted up as we thought was likely to happen. We thought the range would take it up to about 1735. It got through there by a little bit, and again, the S&P 500 is the one we missed the most. So about 80% for the week, which is just fantastic. All right, so now let's get into this and see, this. So what have I done for you lately? What's next? Here is light crude right over here, and you can see the range that we're projecting in there, and the big decline that occurred is it was trading up over here around 28 and a fraction, and then sold over here down to under $23, almost 22, and this was all on Thursday on that disappointing deal that they came out with. Now, there's an intermediate low right over here. When I say intermediate, it really focuses in on the weekly chart. So the sum of the evidence to us appears that the low is in place. And we're going to be looking for still a choppy situation. The bottom of the range here is about 21 and a quarter. The top of the range here are these highs right around 28 to potentially 29. And that's what we're looking for in here over the next week and a half, even longer, and then again trying these areas up over here. So we're looking for a choppy situation. I would be extremely surprised, and it's very low odds to get under that 1927 area. It's very low odds to get much over that 29 area, so we're really looking at what we think is a pretty important range in here. Momentum negative. When you get negative momentum with the slim ribbon you see here, you get sell signals using the projection oscillator. Those are confirmations of the weak condition in there. It's interesting that this was a period in here of some strengthening. You can see that's when the bottom occurred right over here, and now we're getting down over here, but this is not significant when you get down here. It's only when this is positive or green. So we're not really getting a signal here right now. We got the signal right over here of sell, saying it was likely to move down again, and you can see that's what it did. So we're going to just project this range out here, and we're, this short-term view that we do here is really projecting out 1 to 3 weeks, and you can see here 1 to 3 weeks approximately is that range that we're expecting it to stay in. Now we'll look at the gold market. Busy chart here on the gold market because we've got so much analysis. We did a slight revision in here today just to move these cycle rhythms slightly left so that they line up properly. And so we did that and minimally shortened the cycle lengths. And that changed this projection a little bit in here, in that there's a possibility it moves up early in the week, has a little bit of a correction, and then moves up sharply again. We are looking for a minimum upside projection right now of about 1762. That's that fib extension zone right there. Up over here is about 1845. That's where we think it's going, into that fib extension zone. We think that the destruction of paper currency is going to put massive demand on gold. And there has been a shortage of gold as far as the physical and that has been supportive. Momentum in here has turned positive, as you can see right over here. That positive momentum gave you a buy signal right here, or a confirmation on the upside, just like you had right over here and right over here. So that says this market is very strong. Momentum is strong. The intermediate momentum on the weekly chart has turned up, and it's likely going to get through the resistance on the weekly chart. Well, it's pretty much you can see it's pretty much getting through it right over there already. And we're just going to look for a choppy upward market, minimal declines out over here somewhere, and then moving up again. And honestly, for the longer term, well, watch my big picture on gold that we did in the last week. You're going to find it phenomenally valuable. We did that on Thursday, actually. So big picture analysis, gold, and the gold stocks. There's so much in there you won't believe it. So again, you're going to get that video if you sign up for our 1-month trial for just $22.50. You will have that video. All right, so let's take a look as we move out of this gold market, which we're quite bullish on, and move into the dollar market, which generally is opposite to gold. The problem is that the euro currency is very weak, and there's a lot of threat to the even existence of the eurozone. So with the European markets, European currency, the euro, 57% of the dollar index, it's pretty hard to get big declines in the dollar if the euro is going to be weak. Still, the dollar is declining very sharply against the real asset of gold and silver. So it really depends on how you measure it. Here's the pattern in here that we're looking at. So you can see that there was an important low here, and that was this cycle right here. An important low here. Now the cycles have gotten out of phase because this was so long and there was a shift. And it proved to be correct because this rising phase was so powerful there. And the correction comes down right here. So you can see the shift and the new energetic cycle that you see in there. Cycle analysis is a visual look at energies in the market. It's essentially money flow that you can see a picture of. And that's what you have right over here. So we had this rally, and now it's stalling in this minor resistance, gives you that evening star and begins to move down. That gives me a pretty good sense that this upward momentum we were in is stalling. You can see that right there, just moving sideways, potentially rolling over, and that there's a decline coming right over here for the next, we'll call it 5 to 7 trading sessions. Pretty likely to get back down to this area here under 98 that we see right over there. And we see this 1 to 2 weeks of downside risk. There's also a diamond forming in here, and we've talked about a major top, and you can see the diamond right over here when you look at that. So I'm just going to show you. You can see the broadening pattern. That's like that right there and that right there, the trend line, and then the diamond kind of forming, coming out this way. As soon as I get this to draw, there you go, kind of coming out this way and then coming out somewhere this way. And that is, in my opinion, the formation of what will be a big top when this completes. So that's what we have going on right now. We think we're going to get a wave down over 1 to 2 weeks, an attempted rally, and then a downward stair-step action coming in there as the Fed continues to debase our currency to print in order to buy everything up as much as they can. With all of those dollars and the Fed balance sheet skyrocketing, it's probably going to be $10 trillion before you know it. All those dollars out there are going to threaten inflation coming, more dollars chasing fewer goods, and there are certainly fewer goods being produced. That is a setup for an inflationary problem, and that is also a setup for a bond market decline. So that's essentially what we're looking for. Again, this looks like a big top forming, but the euro currency is going to have to gain some strength, and people get confidence that they can survive for the dollar to have any kind of a big decline. So just added in all of those tidbits for you. You could see what happened as this diamond formed. There was a panic buying in the dollar as the economies collapsed around the world, panic selling on QE Infinity right over here, and now getting into this digestive chop. Will it be a big top or will it not? that really remains to be seen and has a lot to do with Europe. That's a look at the dollar. We're just going to look for weakness and a longer period of trading in that choppy downward range. All right, so now we're going to look at the bond market. We talked about the bond market moving to the downside, and that is certainly what it did. We saw a pretty big loss in the 30-year. This is the 30-year right over here. We had a high right there at 183. We had a low right over here at 177. That was a pretty good downside move. And we are failing in that resistance sell zone right over there. We are projecting out here to about May 6th for the intermediate patterns that we're going to continue to move downward. We're going to call the next approximately 4 weeks that we're going to be moving to the downside here in the bond market. I'll show you the stock market. We think we're going to be choppy and moving in a range. So that is not necessarily a great environment with the stock market stable and the bond market looking at potential inflation out there. Well, you lose the safety bid and you're concerned about the printing of dollars, you're likely to see the bond market move down. Our target down over here we're looking at, so the sum of the evidence is that we're likely to get rates moving up. We've showed that on the TNX charts with the targets for the downside in May, somewhere around this area of 170 to potentially down here around 167. And you can just extrapolate that out into the 10s and 20s if that's what you trade. The ZNs or the TLT. So we're looking for declines over here in this next couple of weeks and even further out. That is the short term because we're looking at about 1 to 3 weeks. Now we're going to switch over and we're going to look at the stock market. So the stock market had massive gains. The rebound came from very, very depressed levels after the stock market had its biggest decline ever. Yeah, 35% approximately in something like 4 weeks or a few days less. It was an astounding cascade of selling that came into the markets on the downside. When that happens, when you look at almost every single bear market that began, you can go back and look at the tops all the way in 2007 or 2000, 1962 or 1929, or any of these tops. Almost every one of them that had a sharp decline. Now remember, even the Great Depression didn't start with a decline this big, though it eventually in another few weeks it ended up down 50%. There was always a rebound back, and the rebounds were usually somewhere between the 50% and the 78.6%. So right now we're getting up just to the 50%. It is not an unusual condition for that to happen. And then after every one of those, the bear market started to take a hold. Now the Fed is trying to stop that from happening. They're trying to stop because the economy is shut down. They don't want everybody to think that they lost everything, including every one of their assets they had in the stock market, which were inflated in value in the first place. So that's what they're trying to stop. So right now what we're going to do is we're just going to look at the short term, but the short term is always affected by that intermediate and longer term. And the intermediate forces are now sharply to the downside. So the upward movement is fighting, that short-term upward movement is fighting this downward movement, and that's why you fall afterwards and you stall between that 50 and 78.6%. So here is that ZBs, and now we're going to move over to the SPX, and you'll get a sense for what I mean by a massive downward movement that we had right in here with this a big decline. And when the slim ribbon turned negative momentum right over here, it just lost 1,000 points so fast in the S&P 500. We talked about the early bottom right over here and the anticipation that we would get a rally to the upside. None of this is a surprise. What is a little bit of a surprise is that we thought, based on the extent of the weakness, that the market would stall right around the 2660-70 area, but you could see it's done better than that. And here's that 50% recovery level right over there. Here's the 61.8. I don't expect it to get up here to the 78.6, but these are still reasonable numbers. Now, for the short term, what we're looking for is that this this upward corrective period will remain in play until somewhere out into May. So in other words, this cycle is rallying, it then peaks, it comes down and corrects, and very likely only corrects into this zone, even in the midst of a very bad bear market. That we believe this is a buy zone because the intermediate pattern has turned upward. So with the intermediate pattern in an upward correction, that makes this a buy. That means if you dip down over here to somewhere between 2570, 25, that's actually about 66 right over there, and right over here around 2500, that really is our buy zone, the upper part of that right there. There's a high probability the market will decline into this period right over here. Markets move up through a good portion of the cycle, and then when they release and then begin to come down, they have the sharper declines, as you see right there. If this extends up a few more days right in here, then it will shorten the time period and raise the projection over here. The market will tell us, and that's what we really want to happen. But the probability is high that the market will retreat in here. We're going to call the next 1 to 1.5 weeks a move back downward over here into the buy zone and then move up again. If it takes a couple days to make that downward turn, it's going to raise these levels over here, so we'll be cognizant of that. And then another period out over here of a short-term potential rally back up into these zones, back up near the 2800 level, and potentially getting up here to this area of around 2930, 2935. So this is the trend that you see in here, that we see. This is looking to us like a short-term upward trend living within an intermediate-term rebound that all lives within a longer-term, very bad bear market condition. So there's 3 different time frames I told you about right there. But the downward, heavy downwards condition that we see in the longer term is not affecting this as much right now because the market is in a rebounding period. So we're going to look for this coming week for a decline, lasting about a week and a half, and then moving up again. Momentum has now turned neutral. That is a much better condition. Overall, we're just going to look in the next week, week and a half for this range-bound area, just over 2,800, just down to around 2,566 or a little bit lower, and then moving up again. The sum of the evidence is that we are in a very big rebound from a deeply oversold condition. The patterns that exist in the intermediate condition are negative. Overall momentum for the negative and is for the intermediate and longer term is negative, and the sum of the evidence says the highest probability is that this is a rebound in an ongoing bear market that is going to rear its ugly head again in a very big way. Short-term traders, this is the short-term view. There's room in here to trade both sides of this as we see it. That is our short-term view for stock market and for everything for the coming week. I hope you thought that this was a shortened version of Market Week. We'll bring everything else back in the next week. Again, happy holidays to all. Those of you that celebrating Passover right now, as I am, I wish you the best. We're all sitting home and isolating and connecting with people out in using Zoom and we had a Seder on Zoom, and a lot of people are going to be connecting on Easter on Zoom. I wish you great time with your families, the best that you can have in that venue, and that you all be incredibly safe. It is so crazy out there, and I'm always wishing you great trading.
I'm going to the city and I'm gonna do a steady show. And I know all my fans wanna learn how to make some dough. I've been